Hey everyone, it's Mike from Order Flows and welcome to the Crypto Order Flow Trading course. This is Module 6 on order flow imbalances in the crypto markets. All right, so you've heard me talk about order flow imbalances, and what exactly is an order flow imbalance? Well, an order flow imbalance occurs when there's more directional aggressive trading. So in other words, right, when aggressive buyers outnumber aggressive sellers in the two-way auction over a certain threshold, and usually it's a percentage. You think of them in terms of percentage, like 4-1, 5-1, even 10-1. You would consider that to be a buying imbalance, right? Because you have more aggressive buyers than aggressive sellers by a predefined threshold. Or a selling imbalance would be when their aggressive sellers outnumber the aggressive buyers in the two-way auction. Then you would say there is a selling imbalance. Now, an imbalance can happen anywhere in the footprint chart. And while many bars have imbalances, not every bar does. And that's different from every bar having a delta and a POC, right? Not every bar may have an imbalance. Now, you may get bars that have both buying and selling imbalances, okay? That's not out of the ordinary, okay? Now, sort of one of the important things to note is the colors, right? The beauty of trading order flow is it's very visual, okay? Buying imbalances are blue, selling imbalances are red. The normal order flow in a bar is going to be the black color. So you can see there are selling imbalances in this green up candle, okay? And there are also buying imbalances, just as in this red down candle, you have selling imbalances as well as a buying imbalance. And every bar is different, okay? Not every bar is going to have imbalances at the same level, and imbalances, are the result of the actual trading that's going on in the market. Now, how to determine an order flow imbalance? Well, you have to decide what you're going to consider to be an imbalance, right? Trade that is more or less equal in two-way auction is not going to be considered an imbalance. But if you have, say, 5 times more aggressive buyers than aggressive sellers, then you could say there's a buying imbalance. But again, you have to decide. Most traders use 4-1, 400%. So 4 times as many aggressive buyers than aggressive sellers, and vice versa, 4 times as many aggressive sellers than aggressive buyers. Now, you're not beholden to have to use 4-1. That's the most commonly used percentage. Some people use 3-1. I know even some people that use 2.5-1. Other traders I know that like to blow it out, they use 10-1. Personally, I found that 4-1 is fine for most markets, whether even if it's crypto or stocks or even futures. Okay, 4-1 should be at least your starting point. You can always refine it, if you want to have, depending on your trading method, you want to have, sort of more imbalances, even if it's a slightly I'll say not as strong, but not 4-1. Maybe you want to use 3. Okay. And I know some people that have whole trading strategies built around 10-1, right? They're looking specifically for imbalances in the market of 10-1, meaning, 1 Bitcoin was sold versus 10 bought. Okay. So again, it's up to you to decide what you want to use, but most traders use 4-1. That's nothing wrong with that. It's a perfectly good number. Now remember the order book, right? When you look at the order book, it moves very fast, right? There's a lot of trading going on, especially in crypto, where you could literally buy a few dollars worth of crypto. It's going to show up in the order book, and it's going to cause the order book to change. But really, what you want to do is you want to take the executed trades. They show up on the time and sales. They show up on the executed trade ticker, and you put them into the footprint chart, right? That's what the footprint chart is so beautiful, is because it takes all that information and allows you to use it. Right? I mean, you look at the, your trading interface from the exchange, and there's a lot of information, but most people don't use it because they can't, because it just moves too fast. At least the footprint takes all of that information and puts it into an easy to read format, so you can easily see where the selling imbalances are occurring, where the buying imbalances are occurring. Are they occurring in the middle of the bar? Are they occurring at the edge of a bar? There's a lot of different relationships of the imbalances, right? And they have, generally, you're going to see selling imbalances on moves down and buying imbalances on moves up, but you're also going to see some bars that it's mixed, where you've got them on both sides. When you have them on both sides, for example, this bar here, right? You've got one selling imbalance, two selling imbalances on these green up candles with a lot of buying imbalances. It's telling you that there is some bidding coming into the market, right? Just as when a market is moving up, or not only do you want to see aggressive buying come in, right? That's what you're expecting to see. That's what you have to see for the market to move up. If aggressive traders aren't present in the market, buying the offer, taking the market higher, the market's not going to go up. But when you see the market going up, then you're seeing selling imbalances come in on some of these bars, you know that there's support coming into the market. Just as on the market going down, it's dominated by selling imbalances, but you're also going to see buying imbalances come in. Why? Is because people are also offering it out. They're offering supply into the market for anybody that's looking to buy, right? And when people are supplying the market with more Bitcoin, it's going to weigh on the market. Okay, it's going to help cause the market to go down, because there's always going to be buying, right, in the two-way auction. But if that buying can't get through certain size, there's 5 Bitcoin here, 4.9 Bitcoin here, it's just enough to sort of tip the scales to keep going down, right? It's applying pressure onto the market. Like if the market is selling off and it's just like, oh, okay, well, maybe now, buyers are stepping in, but there's still a bit of more Bitcoin, being offered out. It's there to stop any moves higher. Now, there are different types of imbalances when they come in groups, so to speak, right? We have stacked imbalances, multiple imbalances, inverse imbalances. And that's the beauty of order flows, because not only do you have that information, but you could dive deeper into order flow imbalances, right? And when you look at imbalances, right, you really get interested in those bars that have, more than 3 imbalances, right? You can even, choose 4, right? You think of an imbalance in the imbalances, okay? Now, stacked imbalances, multiple imbalances, and inverse imbalances, each one is important in its own way, right? So you have different types of imbalances. So a stacked imbalance we'll start with first. And that occurs when there are 3 or more imbalances stacked neatly on top of each other. A stacked buying imbalance is 3 or more buying imbalances stacked on top of each other. A stacked selling imbalance is 3 or more selling imbalances, right? So when you say stacked buying imbalance, right, it's going to be 3 or more buying imbalances. A stacked selling imbalance is going to be 3 or more selling imbalances. And stacked imbalances often occur when momentum picks up, right? Also, when a big trader sweeps through the market. Okay, a market is undergoing, it's currently in a flow-driven market. You're going to see generally stacked selling imbalances because there's a lot of aggressive selling going on. Just as when a market starts rising, you're generally going to start seeing the stacked buying imbalances come in. Now, it could also be a sign that a big trader is active in the market, that he's coming through and is, I don't say bullying the market, but he wants to get his order done and he wants it done now. So stacked selling imbalances, what they look like: 1, 2, 3, a minimum of 3, 1, 2, 3, 4, 1, 2, 3. These are stacked selling imbalances. There's another one down here. Now, if there's space in between them, like here's a selling imbalance and 2 prices lower, there's another one, and then 3, 4 prices lower. This is not considered a stacked selling imbalance because they're spread out. Okay, now that's going to be the next thing that we'll talk about. But stacked buying imbalance is similar to a stacked selling imbalance, but only it deals with buying imbalances stacked on top of each other. 1, 2, 3, 4, 5, 6 buying imbalances in this bar. You would consider this a stacked buying imbalance. Here, you would not consider this to be a stacked buying imbalance. There's only 2. You would need another one to make it 3. Okay, even though this bar's got 1, 2, 3, 4, 5, 6 buying imbalances, 3 of them are not grouped with each other. Okay, so that's not considered a stacked buying imbalance. Now, one of the problems that I saw a lot of traders making with order flow is only looking for bars with stacked imbalances. And this is especially true when you're on a shorter time frame. Okay, so 5 minutes, 15 minutes, then up, you're looking at a lot of data. Okay, but when you're on a shorter time frame, when you're scalping the market, and you're starting, you don't get as many stacked imbalances. So when you start seeing two, then the space, regular order flow, like if you see it like here, I got two buying imbalances, then regular order flow, then another one. People that are looking for stacked buying imbalances would disregard this altogether. And I would argue with them and I say, no, you can't, right? Just because it's spread out, sometimes it's spread out by one price level, it's still important, right? And you want to pay attention to that. Again, now some bars may have more than one stacked imbalance, right? This bar's got 3 stacked buying imbalances in them. So what I was just alluding to a second ago, the multiple imbalances in a bar. And multiple imbalances in a bar is when there are 3 or more imbalances in the bar, but spread out at different points in that bar, which is unlike the stack imbalance, right? Stacked imbalance they have to be stacked neatly on top of each other. Multiple imbalances in a bar is the same direction, but spread out throughout the bar. And they're just important as stacked imbalances. And sometimes I think they're more important because, one, everybody's looking for stacked imbalances, and they're going to overlook those bars that have multiple imbalances because they're not stacked neatly on top of each other. And but more importantly, it shows you how aggressive trading was at various points in a bar. And when a bar starts showing 3 or more imbalances, even though they're spread out, it's still a strong sign. And you often see bars with multiple imbalances before you see bars with stacked imbalances. And that's the second most important part of it is it sometimes gives you a clue as to what's about to happen in the market before it actually happens, right? If you start seeing aggressive buying come in, so I say you come into a swing low, and you start seeing aggressive buying come in, but it's sort of spread out in the bar. Are you just going to disregard it? No, you shouldn't, right? Because by the time the stacked imbalance comes in, it could be 2 bars later after the market's already made a move, right? And then you're just sort of stuck on the tail end of the move when there were sort of signs of life as the bottom was being made and the aggressive buyers were coming into the market. So multiple imbalances in the bar, right? This is what I'm talking about here, right? We came down into this low, and you've got 1, 2, 3, 4, 5 imbalances, but they're not stacked neatly on top of each other. Here you have 2, then you got 1 and 1 and 1 down here. Are you just going to disregard these buying imbalances? You shouldn't, right? You don't get any buying, any stacked imbalances coming in here, right? Because once you start putting it together, okay, the market sold off, we came down into a swing low. I got aggressive buying coming in here. I've got these multiple imbalances in the bar, and then it just sort of goes sideways, a paired aligned POC. But now I'm seeing supportive bidding coming into the market with this green bar with the negative, aggressive, the selling imbalances right here, the red. And then the market pops up. And again, if you're just looking for stacked imbalances, this is a trade you're not going to notice. You just be like, well, no, I'm looking for a stacked imbalance or nothing. And then there's no stacked imbalance, so I'm not going to take the trade, which I think is a mistake. Here's the market. It's just sort of going sideways, right? You get a couple buying imbalances here, a buying imbalance, a couple buying imbalances here. Then you get 1, 2, 3, 4 selling imbalances. Now they're not neatly stacked. You got 2 here, 2 there. But what's happening is the market's starting to break out of this lower end here of 42,300. But you're seeing aggressive sellers coming in as you're coming into that low, and then you're still seeing aggressive sellers as you break out of that low, right? But again, if you're looking for stacked selling imbalances, you're going to miss this trade. So look for multiple imbalances if you're breaking out of an area, if you're just coming off a swing high or a swing low. And again, it doesn't have to occur right at the swing high or swing low. It's nice when it does, but it could be like the bar afterwards, or even 2 bars afterwards, especially if you got other aspects of order flow that is also telling you that, hey, you know what, there's a potential reversal going on, right? Just like here, coming down in here, make this is the swing low here, the next bar, multiple imbalances, you got some nice positive delta and just sort of go sideways, then I see the supportive buying coming in here. Okay, that's my cue. Yeah, I should be looking to get long, right? Because I know I got this aggressive buying here. If I was to get long right now, where would my stop be? Well, I got all this aggressive buying. I could just go right down in here somewhere, 43,000, right? And catch a nice trade higher. All right, now that is multiple imbalances in a bar. So when you see a lot of bars with multiple imbalances, you want to look for them appearing after periods of quiet activity, right? When you're breaking out of some sideways actions, and you're going to look for them at swing highs and swing lows. Now, the last sort of stacked imbalance I want to talk about is the inverse imbalance. And the inverse imbalance is a sign of trapped traders, and on the flip side, absorption. Okay, because when people get trapped, they, in a sense, are being absorbed by somebody. Okay, aggressive traders get ahead of themselves and ran into big passive passive traders who are just happy to either sell all they can to these aggressive buyers until these aggressive buyers can't buy anymore, or bought from the aggressive sellers until the aggressive sellers had nothing left to sell. So, as the market is going up, right, you're going to see trapped buyers, just as when the market is selling off, you're going to find trapped sellers. And the easiest way to think of it is someone that buys the high or sells the low. It doesn't have to be the high of the day or the low of the day. It could be the low of a move or the high of a move. Okay, and you look at it as a reversal signal. Now, not all the times they're going to be reversal signals, but generally they are reversal signals. And inverse imbalance. Okay, so here you have your inverse imbalance, right? It's a stacked selling imbalance in a green candle. Okay, you would think that this market should sell off, right? I got the aggressive sellers, but what's happening is they are absorbing all that selling that's going on. And as long as the market stays above, right, it's not going to be selling off. You should be looking at this as support to hold, right? This is probably a good opportunity. You can always sprinkle some bids in here for the market to come back to and participate as the market goes higher. Now, here's the inverse imbalance, the bearish sign, right? We are selling off, then you got supply coming in here to absorb whatever buyers there are. People want to buy. Oh, we're selling off 39,200. Buy the dip. Well, all these people are buying the dip, 39,150. Then the market dips again. Buy the dip again. Right? People are offering it out there. They're happy to sell it to them. So when you have an inverse imbalance, a bearish one, right, it's going to be a stacked buying imbalance in a red bar, and you want to be below the imbalance. Okay, if you are above the imbalance, then sort of all bets are off. But the way to trade it is you have the stacked buying imbalance, you're looking to short, right? Just as if you have the stacked selling imbalance, you're looking to go long, right? You're not looking to sell into the stacked selling imbalance for the market to go down. The way you're treating it right now is that's your sign to get long. So this concludes Module 6. Now let's move on to Module 7.